Right. Good morning, investors and traders. That's right. Good morning. We are coming to you at 6 o'clock a.m. Wednesday morning. My name is Seth Gold, and welcome to Finom Group's latest video. A lot of consternation in the markets amongst investors, strategists, analysts alike as to what's going to happen next or how 2023 in general is going to play out. So today we're going to run through some analysis that may help to answer a lot of the unanswered questions that investors have. In order to do that, we're going to listen to a video here and keep in mind that I've been, I don't want to say arguing, but analyzing the prospects surrounding the plausibility that 2022's bear market has already priced in the ramifications and or adverse effects of the Fed's rate hiking campaign and inflationary regime, suggesting, in other words, that 2022 may have, to a greater degree, already priced in an inevitable or eventual, as many investors and strategists believe, recession that may actually materialize by the end of the year. Mild recession, deep recession, the opinions vary, but the majority of investors, strategists, and analysts do believe that a recession is inevitable by the end of this year. So with that in mind, want to kick off this video because this is a great way to start with Lori Castelvina, sorry if I pronounced her name wrong, appeared on CNBC with a very similar hypothesis that I've been offering since basically the start of this year. So let's get into the video, and we're going to have a little fun along the way.
Here on set. So this goes perfectly into the question that prompted you to write the note. That is, has the stock market ever priced in a recession before it's happened?
Right. And we've been getting that questions from investors who are frankly, I think sort of feel like Dan, but are looking at the market action and saying, why are we higher? What's the bull case? And we kind of walk people through what we think the bull case is. And then people say, okay, fine, but we haven't even seen the recession start yet. So how can we possibly have priced it in? And look, we've gone back and said it would be, it would be odd, but there's some precedent for it. If you go back and look at the history books, if you go all the way back to 1945, that was the recession coming out of World War II.
So there is precedent, folks. There is precedent.
Stock market just marched through it. It's the only recession where it's essentially been ignored. And I think...
Is she right? Is it the only recession that the stock market ignored?
That there are a lot of differences between today and that time period, but there's some similarities as well.
So that's the only instance?
That's the only instance.
That's all you got?
That could be.
Notice the laughter, the disbelief.
Convincing to me if it's one instance in such a long time period, and there are notable differences between that period and this period.
Well, I think what's interesting is people say, we've never done this. And I'm like, well, we've never done this, but we have done something kind.
Usually when people say we've never done this before, they're not completing the sentence. It's more like, well, this has never happened. We've never done this in my lifetime. Just because it hasn't happened in your lifetime doesn't mean it hasn't happened.
Kind of similar. And the thing that's similar is that you had this massive decline in the market ahead of it, about a 43% drop early on in the war. And actually, even after you had the mid-war bottom, you saw a 13% drawdown in 1943. The recession was not till 1945. And when I was researching this, I actually found some interesting terms that were similar. It was described as a technical recession, just being driven by the fact that the wartime economy was shutting down and we were pivoting to a peacetime economy. So this kind of idea of a manufactured recession that we were all talking about last year, you actually had it back then.
Also COVID. I mean, what are we calling that, right? I mean, that was so much like a war economy, if you think about it. And
yeah, but we threw $6 trillion at it. And that's why we had a rip-roaring market in 20.
Now we have to excuse it because of fiscal and monetary policy. That's what the naysayers do. They look for excuses to downplay the fact that markets are rather consistent. They're forward discounting mechanisms, but it's just hard to believe that in the moment.
2021 and 2022, and look at what expected growth is. Look at where inflation has gone and likely to stay elevated relative to that. Look,
And wouldn't you know who's doing this naysaying, becoming, or not becoming, but the consistent pundit of any bullish prospects, of any bullish thesis and idea? Dan Nathan, the perma bear himself.
with the prior 10 years that we had a GDP to the pandemic, we averaged 2.2%, and we're not likely to get meaningfully above that with higher prices, and rates are going to reset higher. So to me, I mean, I don't see anything about that comparison that makes any sense given where we are right now. And I think the pandemic really.
It's not that you don't see it, it's you don't want to see it. There's a dedicated bias here with Dan Nathan.
Why are you looking at me like that? Why are you looking at me like that?
Because you have a very, Seth, if you have nothing nice to say, don't say anything at all. But the panel is looking at him because they know. They know. It doesn't matter what you say to this guy. Perma bear, perma bear, perma bear. Perma bears will do what perma bears do.
If you go back again to this 1945 example, you had massive government resources that went to fuel the wartime machine, and that was pulled back in a hurry. We're kind of doing something similar this time around, both on the fiscal side and the monetary.
So just to kind of clarify, Lori Calcavina is talking about the 1943 to 1945, which 45 we had a recession, but we had a bull market. I'm going to show you some other examples.
Side. Also, unemployment managed to stay very strong back then, and that's kind of the other head scratcher in this environment. How in the world has it stayed so strong?
Yeah, but you don't really believe that. You're just playing devil's advocate right now, right?
Well, see, I actually.
No, this has to be a farce. The analysis is what it is, but in real time, we don't believe the past. History doesn't repeat, let alone rhyme.
In a recession back at the October lows, but I think people are tired of hearing that, and I had to have something else to talk about, frankly. And so, the idea that people keep saying, "Well, we've never done this. We've never done this." It's like we've done something.
So why would they have priced it in this time then? Because that may be right. In other words, and everyone's also saying, "Get me back to 3,600 on the S&P, and I'm a buyer at two hands." And I don't think they're going to be on the way down.
They won't be any more than they were a buyer with both hands at 3,500.
Why would we have priced it in when, in fact, it's the same question? We haven't done this before. I hear you, and this time feels so different on so many different vectors. We haven't seen the. It's
different every time. That's the reality. Every time is different. There was not two dot-com bubble bursts. There was not two 9/11s. There was not two great financial crises. More than likely, there's not two pandemics.
Fed hike this aggressively. We haven't come out of a place where the economy was waking up, but. Again, why would we do that now?
Well, look, we did it back in October. And if you think about what was driving us to those October lows, it was, oh my God, the Fed is tightening. It's all these big chunky hikes. We're going to have a recession. It was literally the Fed and fears of the Fed causing a recession that drove us to that point. The other thing we saw pretty clearly was.
And here's the point I want to make. Everybody says, no, we were pricing in rate hikes. Here's the thing, folks. The Fed is controlling the economic, or to one degree or another, based on their dual mandate, they are controlling economic output, GDP, growth or contraction, limiting or expanding by ways of monetary policy, and fiscal policy can add on to that as it did during the pandemic period. But when people say, no, the reason why we had a bear market last year was because of rate hikes resetting the equity risk premium. Any variable that you throw at why we had the bear market last year, rate hikes, inflation, blah, blah, blah. It's only a certain degree separation from monetary policy. It's all monetary policy in the end, which again is a force factor on the economy, i.e. recession or expansion. That's why I say, no matter what you throw at it as an excuse to, why we had a bear market last year, it all leads to pricing a recession as a adverse effect of monetary policy.
Was over the summer, the small caps were baking in a recession. They were baking in an ISM down around 39 if you look at the manufacturing gauge, and valuations were literally at the rock bottom of the historical range. So if you look through that lens first, it makes a little bit more sense that the S&P just had to catch up to where the Russell was over the summer.
So here's my question to you folks. And this is where we have a little fun.
Is she right? Because I know that's the popular version of what went on there. And a lot of people like to believe that. I wish I could, but I was there. I wasn't here in the classroom hoping I was right, thinking about it. I was up to my knees in rice paddies with Johnson Edwards going up against Charlotte, slugging it out with him while pussies like you were back there partying, putting headbands on, doing runs. Listen to the goddamn feeling.
All right, Sam Kinniston. But is Lori Castelvenus, is she right? Again, forgive me if I say her name wrong. All right, hopefully we're having a little fun, but more importantly, let's explore. Let's find out, is she right? The reality is there's no right or wrong. What we're looking for here is whether or not there's precedence. Now, Lori Castelvenus exercise, and she's the strategist at RBA Capital, identified that there is precedence. It's happened before in the post-World War period. 1943, 1945, the recession happened, but we still had a bull market through the recession. I'm going to show you that we didn't just have it that time, and she may have overlooked other occurrences. So here's an example, pretty much around the same time period. Blow it up a little bit here. This is 1947. It's almost identical to what we're going through now, folks. It's eerie. It's disgustingly eerie. 1947, these arrows right here, and this is real gross domestic product. 1947, back-to-back negative GDP prints, right? Didn't we just have that in the first and second quarter of 2022? Familiar, right? Look what happened here. We didn't have the recession until 1949, folks. 1949. Didn't have the recession. People have been clamoring. This was a technical recession. Again, just like 1944, 45. The bottom chart here is the S&P 500's annual return. Here we were, 1946. We had a decent decline, almost 12%. Through 1948, it was about a 13% decline. Is that a bear market? No. But my friggin' God, right? 3 years where the stock market was basically down. Do you not think it felt like a bear market? Absolutely. Look where the recession occurs, 1949 into 1950. Look at the S&P 500, 1949 up more than 10%. 1950 market kept going. Recession returns. Why? We did nothing for 3 years. Tell me it's not priced in. That's another example. So now we have 2 examples based on Lori's example and the 1947 through 1949, 1946 through 1949 period. And here's the thing, folks. There are many bear markets without recessions, and that's what this table here shows. This is from LPL Research, their table. And you can see 1946 to 1940, a 28% bear market without a recession. Now, before the present period, that was basically the longest bear market in history without a recession. But here are the other examples of bear markets or near bear markets, like 19% plus. On an intraday basis, I guarantee you it dropped 20%. But these are closing basis drawdowns. So do keep that in mind. All right, moving forward. And this is why I say I think Lori just overlooked. Sometimes you can get tunnel vision in the work that you're doing, and you get stuck on one time period, and you just dedicate too much time, and you gotta turn in your report. So here we go. Here's another occurrence. Now, you've heard me talk about this. Our Finom group members know that I've talked about the 1976 through 1980 period. Very, very similar circumstances. And by the way, folks, when we look at this period here, 1940, I guess that 47 to 1949, we can also look at like circumstances. Well, every time is different, but there's a lot of similarities, as Lori was also pointing to. Look at this is a chart of CPI or annualized CPI. Look at 1946. 18% inflation. Yeah, it fell down to less than 9%, but in 1947, you still had almost 9% inflation. 1948, it kept going lower. And then you get the recession in 1949. Well, we had already priced in the ramifications of higher rates due to the Fed needing to basically fight inflation. Now, prior to this, they weren't fighting inflation. In fact, one of the benefits coming out of the post-World War II period was back in 1942, the Fed had actually put on yield curve caps, meaning that they would only allow Treasury bond yields to float so high. And once they, hit the ceiling, they couldn't go any higher. But then in 1947, they took them off. And wouldn't you know it, inflation was really catching fire. Till 1949, we basically had, the recession. So like circumstances, not exact, but like circumstances. All right, so going back to 1979 to 1980, same situation, folks. And most of you have heard of the inflation regime during the 1970s, right? And here we were, 1976, and here we go again. 77 CPI, 78, 79, 1980 starts to come down, keeps coming down, 1981, 1982. Now, in 1982, we peaked at about 8%. That's why most people reference this is the highest inflation, that we've had in 40 plus years. Last year, 2022, inflation got just over 9%. All right, so let's look at that period and the returns. 1976 through 1980. And you can already see 1980, big positive year, right? But look what happened through this time period. We had a bear market from 1976 into 1978. It doesn't necessarily look that way because these are, green candles. It actually looks like we were positive. But go back to our bear and near bear market history, we did have a 19.4% drawdown from 9/21/1976 into early 1978. I think we can show that also on the charts. Here we are, 1976. We ended on a high note, folks. Look at the date, right? Basically the day after Christmas, 2 days after Christmas, the market peaked. And it was downhill from there. Over to the left side of my screen, you can see the closing value is 107.46, dropped all the way down to the low. Here it looks like February, basically 6 months later, almost 3 months later, February 27, 1978, 87.45 on the closing. That is exactly 20%, exactly 20%. That's a bear market. But then look what happens. We go up, and away. Here, 1980. Basically, the end of the end of November 1980. It was a roaring bull market through inflation. Again, look at inflation. 1979, 1980, through the inflation period and through the recession. This is real GDP. There's the recession. Roaring bull market. Why? Again, basically 1976 through 1979, we went nowhere. It wasn't we had the, intra-bear market period that was essentially pricing in the negative impact of higher rates. Once the recession hit, market already knew. It's priced in. That's 3 examples where we had a bull market through a recession, through high inflation, through higher interest rates. All right, moving on. Again, is she right? It looks like Lori's right. It looks like I'm right. Again, we can't predict the future, but we can learn from the past. What we've experienced recently is the shortest bear market or fastest bear market in history. Let's see, bull markets. Yeah, here it is. We started on 3/23 of 2020, right? That was the bear market bottom from COVID. 22 months later, that bull market ended. It's the shortest in history. Next to the 1966 through 1968 bull market. So this is the shortest and fastest bull market in history, folks. And what I ask, the current bear market has proven the longest bear market without a recession in history, post the World War II period. Would you be surprised if the recovery was the weakest in history, but a recovery nonetheless, even if a recession materializes in 2023? We've had the shortest and fastest bull market in history. And now we've had the longest bear market without a recession in history. So would you be surprised if this was the weakest recovery in history? Strategists, as you heard, on the CNBC clip, strategists are willfully denying the ravenous rapidity of the cycle, which may be proven to be the fastest cycle in history. And here we are looking at that 1966 period, right? That was the former fastest bull market and shortest bull market in history. Looks a lot like today, folks. And that was a midterm election year into year 3 of a 4-year presidential cycle. This is what happened in 1967, right? Are we up and away in 2023, which is also year 3 of a 4-year presidential cycle? Like history, folks. History has this really funny way of repeating itself. I'm not saying this is exactly what's going to happen. Again, it can't predict the future. I don't know if an exogenous event is going to come out of nowhere. Going back to what I also had mentioned earlier about rate hikes and people excusing last year as not pricing in a recession in favor of pricing in just, a change in the equity risk premium to adjust for higher rates. I will remind you, everything associated with the economy, everything the Fed does is associated with the economy. It's just the degrees of separation before we get a recession. Rate hikes are associated with future recession. Equity risk premium is an indicator. The yield curve is an indicator of what? Recession or expansion. One way or another, you are pricing in the economic climate ahead. The market is a forward discounting mechanism. And this proves, historically, the market goes higher. This chart here again from LPL Financial, S&P 500 index performance during periods of multiple Fed rate hikes since World War II. The average is a gain of 11% through the rate hike period. The median, 11%, higher 72% of the time. Usually markets are higher during rate hike cycles. That didn't happen this time. We had a bear market. Not only did we have a bear market, the bear started before the first rate hike. We were pricing in those rate hikes, that potential recession, which is not normal, as evidenced here and outlined by this chart, this table from all the rate hike cycles since 1955 by Ned Davis Research. How do we know the current cycle is unusual and may prove to have priced a recession ahead of a recession? Because the bear started before the first rate hike, which is not normal. The S&P 500 began pricing in Fed policy and economic cycle earlier than usual, basically began the pricing the second trading day of January 22nd. Bear markets start a median of 7 months after the first rate hike. This bear began 2.3 months before the first rate hike, recalling that the first rate hike didn't happen until March of 2022. The lead time from the first rate hike to a bear market has only been longer 2015 and 1978, going back to our 1970s analog study. So I guess what I'm trying to say here, folks, is everybody's leaning to one side of the boat, and they're denying that today's market cycle does not have precedence, that there's no way that we could have forward priced the recession. And I always go back to the same question, and I wish that, in these financial media programs, they would ask the strategist, the analyst, the naysayer, the pundit, what do you think last year's bear market was about? It just happened because it's usually not how it works, folks. And where I don't want to see too many investors invested is in regret, because usually this is how it plays out. What plagues us as investors is the concerns between now and the future. I think the year-to-date price action and this chart right here speak volumes. Every prudent risk management measure you take generally results in missed opportunity, not a reduction in losses. And by the way, there's no winning in loss reduction. There's no profit in loss reduction from risk management. You only get paid to take risk, folks. So don't be found regretting the bear market's true gift, value opportunity. See, today, this is what we learned from the past. We missed opportunities. And this goes back to what Tim Seymour said in that CNBC clip. Everybody's waiting, they're willing to buy, with double, with both hands. If we get down to 3,600, 3,500 again. Why weren't they buying back then? Because they weren't. And that's the missed opportunity. And they'll miss it again should we get back. And I'm not projecting we will or we won't. This is analysis. This is a deep dive. Unfortunately, this is how we are looking forward. All we see is the risk. That's how most investors approach the market. They see nothing but risk. In hindsight, we see the missed opportunity. I feel that this encapsulates the majority of market participants today. Just don't want to see it happen to you. With that being said, if you like this kind of analysis, take us up, visit us at phenomgroup.com, and we'll see you in the next video. Have a great trading day, folks.